In the last 10 months, Kenya has imported about 70% of its sugar from East African Community member states and the Common Market for Eastern and Southern Africa, COMESA, despite production nearly doubling in this period as compared to last year. Lilian Kiarie with more.
It's been a sweet and sour period for Kenyans, with retail prices of sugar being as unpredictable as the weather patterns have been lately. Constant low cane production, the high cost of producing the commodity, and competition from cheap imports causing this shift. At the beginning of the year, sugar retailed at an average of 107 shillings per kilogram, declining to 101 shillings per kilogram in May, and then rising to 152 shillings per kilogram in August. Then to 146 shillings in September and declining to 124 shillings in October. Total sugar inputs in the last month increased by 5,239 tons from 18,173 tons last year in October to 23,412 tons last month. Production of the commodity in the last 10 months also recorded a 45% increase at 411,567 metric tons compared to 284,036 metric tons attained in the same period last year. In the last 10 months, most of the sugar factories, with the exemption of Muhoroni, Mumias and Nzoia Sugar Company, recorded an improved production, with West Kenya and Transmara recording the highest production respectively. The production was boosted by operationalization of Olepito Sugar Company and inclusion of processed bulk sugar imports at West Kenya and Sukari mills. In the month of October 2018, local sugar price averaged at 4,828 shillings per 50 kilogram bag, whereas imported sugar averaged at 4,642 shillings per 50 kilogram bag. Thus, imported sugar was cheaper than local sugar by 186 shillings per 50 kilogram bag. Packaging costs led to local branded sugar companies charging 20 shillings more than loose sugar at an average of 138 shillings per kilogram. Lilian Kiarie, NTV Business.